Jeffrey Epstein, a name that makes billionaires go quiet and governments change the subject. $577 million. That's what Jeffrey Epstein was worth when he was found unresponsive in a federal facility. He had no verified clients, no licensed firm, no explained income for over 30 years. $577 million. From nothing. Hidden in trusts, shells, and offshore accounts across 4 jurisdictions. And 5 years after his death, prosecutors still can't touch most of it. This isn't a story about a predator. This is a story about how money disappears and who helps it. Everything you've heard about Epstein is a distraction. The real story was never about him. It was about the machine he ran and the people who built it with him. And here's exactly how he pulled it off. The financial structure so clean it was never technically illegal, and so sophisticated it took the FBI years to partially understand it. Why the banks didn't miss the red flags. They saw them. They chose him anyway. How a man with no license and no clients controlled $577 million and kept every cent hidden from the IRS for 30 years. The document signed 48 hours before arrest that made the money untouchable forever. And the question that could bring down people still in power today, if Epstein was just the door, who built the house? New York City. A 23-year-old college dropout walks into Bear Stearns and gets hired as a math teacher for the firm's internal training program. No degree, no finance background, no credentials. 4 years later, he's fired for regulatory violations. Story over, or so it seems. Fired. No degree, no connections, no money. And yet, in 8 years, he'll be controlling a billionaire's entire financial life. How? In 1982, Epstein opens Epstein and Company. His pitch, he manages money exclusively for billionaires. Only clients with over $1 billion in net worth. Ultra exclusive, ultra private. Over the next 20 years, not a single named client surfaces. Not one contract, not one audited statement, not one SEC registration for investment advisory services. There is only one name that appears in the documents. Les Wexner, founder of L Brands, the conglomerate that owned Victoria's Secret and Bath and Body Works. In 1991, Wexner signs Epstein a power of attorney, one of the broadest ever documented in American legal history. Epstein is granted the right to or buy and sell real estate on Wexner's behalf, control his bank accounts, hire and fire his employees, manage his assets at will, with zero oversight required. And then Wexner hands Epstein the Manhattan Mansion for $1, a property worth at least $13 million at the time, one that Epstein later valued at $56 million when using it as collateral. That's all lesson 1 of the financial con. You don't need your own money. You need access to someone else's. But Wexner was just the beginning. Here's what most documentaries skip entirely. By the mid-1990s, Epstein had built a second network, completely separate from his financial operation, a network of scientists, academics, and institutional donors. He gave $6.5 million to Harvard University, $30 million to fund a scientific research program at Harvard's Program for Evolutionary Dynamics, donations to MIT, to the Santa Fe Institute, to Rockefeller University. This wasn't philanthropy. This was infrastructure. Because when your name is on a university building, you stop being a suspect. You become a patron, a visionary, a man of science. Every donation bought him something more valuable than a tax deduction. It bought him legitimacy. And legitimacy in the financial world is the most expensive thing money can buy. Think about what this means structurally. You have a man with no verified income, no licensed firm, no explained source of wealth, writing 8-figure checks to Ivy League institutions, and nobody asked where the money came from. Not the universities, not the IRS, not the SEC. Because men who give $30 million to Harvard don't get audited, they get invited to sit on boards. But there's another layer that almost never gets reported. Epstein didn't just collect powerful people. He collected their ideas. He hosted annual gatherings on his private island and at his Manhattan mansion, bringing together Nobel laureates, hedge fund managers, sitting politicians, and tech billionaires. These weren't parties, they were information exchanges. And Epstein sat at the center, listening, connecting, accumulating. In intelligence circles, this is called a collection operation. You don't need to steal secrets if people volunteer them over dinner. By 2000, Epstein had leverage over people in science, finance, politics, and media simultaneously. Not because he was powerful, because he knew things about powerful people that they desperately needed to keep quiet. And that, more than any offshore trust, more than any shell company, was his real balance sheet. Let's break down the mechanics. When Epstein relocated to the U.S. Virgin Islands in 1998, it wasn't a lifestyle choice. It was a tax strategy. The U.S. Virgin Islands is one of the last American jurisdictions where you can legally pay up to 90% less in federal income tax, while still holding a U.S. passport. Epstein registers a company there, Financial Trust Company. On paper, an investment advisor. In practice, a black box. Financial Trust Company controlled at least 15 subsidiary entities, each registered in a different jurisdiction: the U.S. Virgin Islands, the British Virgin Islands, Panama, New Mexico. Classic layered offshore structure. Here's how the money moved. Money enters through Company A with a legitimate-looking invoice attached. Company A wires to Company B, documented as consulting services. Company B sits in an offshore jurisdiction. Tax rate? Near zero. Company B sends money back, now labeled investment returns. The money has traveled a full circle. No taxes paid. The origin is untraceable. This is what financial crime investigators call dirty money in a clean envelope. But Epstein had one more layer, almost elegant in its simplicity. His most valuable asset wasn't real estate. It wasn't stocks or offshore accounts. His most valuable asset was people, specifically their secrets. In finance, leverage means using borrowed capital to amplify returns. Epstein invented a different kind of leverage. Court documents from proceedings between 2019 and 2024 confirm his Manhattan mansion was fitted with hidden cameras throughout. Photos, video, names. This wasn't just a crime. This was an asset. Because a man you hold by the throat will open any door, introduce any investor, sign any document. That's why hedge fund managers, government officials, and corporate executives moved through his network. That's why Citibank, Deutsche Bank, and JPMorgan kept his accounts active, despite the fact that their own compliance teams flagged him repeatedly. Internal JPMorgan documents released during 2023 litigation show this in black and white. Bank employees directly noted suspicious activity, large cash withdrawals, unusual wire patterns, the client's criminal background. The bank's response: client is of strategic value. They kept him. Because access, in the right circles, is worth more than any transaction fee. And here's what you need to ask yourself right now. If JP Morgan knew, if Deutsche Bank knew, if Citibank knew, and all three of them chose to keep him anyway, who exactly were they protecting? Because it wasn't Epstein. Epstein gone in a Manhattan federal jail cell in August 2019. Officially, an incident the medical examiner couldn't fully explain. At the time of his death, his estate was valued at $577 million. Victims' attorneys filed claims totaling nearly the same amount. Here's the problem. Most of that money, legally, did not exist. The assets had been transferred into trusts. Under American law, a trust is a separate legal entity. You do not own the assets inside a trust. You are a beneficiary, or a trustee, or sometimes, if structured correctly, neither. Epstein had been building his trust network for years, but the critical move came just days before his 2019 arrest. He rewrote his will, transferring virtually all remaining assets into an entity called the 1953 Trust, named after his birth year. He signed it 48 hours before the case against him was supposed to go further, while already in federal custody, while the investigators were closing in. This was not panic. This was a contingency plan executed on schedule. But here's what nobody reported. The trust wasn't just a legal shield. It was a message to someone that the money was safe and the names inside it were safe with it. Trusts are legally shielded from direct personal liability claims. Assets inside them are technically not yours. Clawing money back through trust structures is exponentially harder than seizing a personal bank account, which is exactly why, 5 years after his death, the estate's settlement fund is still paying victims in installments. Not because there isn't enough money, because legally proving the right to it is almost impossible. Here's the question almost no one asks. Not how did Epstein do this, but why did the system let him? The answer is uncomfortable, because the system isn't broken. It's working exactly as designed for a specific class of people. First, regulators respond to complaints. They don't act proactively. FinCEN, the Treasury Department's Financial Crime Enforcement Unit, received suspicious activity reports tied to Epstein's accounts. This is publicly confirmed. No investigation followed. Second, banks pay fines. They don't go to prison. JPMorgan ultimately paid $290 million to settle Epstein-related claims. Deutsche Bank paid $75 million. These are not punishments. They are operating cost, priced in. Third, offshore structures are completely legal. The U.S. Virgin Islands, the Cayman Islands, the British Virgin Islands, these are not dark alleys. They are official jurisdictions with tax frameworks explicitly permitted under American law. That's why Forbes and Bloomberg still publish pieces on legal tax optimization. Because technically, it's true. Epstein's operation was not an anomaly. It was the extreme end of standard practice. So why does this matter to you personally? Because the same structures he used are managing money in your country right now, legally, openly, with government approval. Epstein was not the predator at the top of this chain. He was the door. Everything he used, the trusts, the shells, the information files, exists today in different names, different islands, different accounts. The machine didn't die with him. It just got quieter. The money is hidden. The names are protected. And the one man who could have talked never got the chance to testify. You already know what you think about that? Say it below. Because the algorithm buries this kind of content. The only thing that keeps it alive is you. What do you think actually happened inside that facility? And who do you think was really behind this?